So let's get into this. First question that a lot of people ask is, when is a good time to buy? Now, that's one of those questions that is very unique to each individual. So the right time to buy is when you're ready to buy. Don't look at the marketing of the news talking about interest rates being up or interest rates being down. Look at the economy in your pocket, and then you can decide if you're ready to buy. So as they say, don't wait to buy and wait, because historically, house prices go up in the long term. You may have some ups and downs in the short term, but in the long term, house prices are going to go up. How much can I borrow? How is it calculated as far as a mortgage? I've come up with something called CID, C-I-D, which is credit, income, and deposit. So what a bank will do, they will look at your credit profile, not just your credit score, but your credit profile. What I mean by that, your score may be high, but you may have missed payments in the last 3, 6, 12 months, which means you may not qualify for some products. Then they're going to look at your income. As a rule, they're going to multiply your income, so the amount that you make, by either 4.25, 4.5. It's going to depend on the type of job that you have and some other factors. So they're going to multiply your salary times a number. Let's keep the numbers easy and say you're on £25,000 a year, and they multiply it by 4. Then that would give you a mortgage amount of $100,000. So that's the amount of the mortgage you qualify for. But then let's just say you had £100,000 sitting around somewhere. You would take the amount of the mortgage you can get, which is $100,000, and add the deposit that you have, which is $100,000. So that means you could actually purchase a property for $200,000, because the $100,000 you're paying down would be deducted from the house price, which would leave the mortgage amount of $100,000. That leads me into loan to valuation. That's something that people ask about a lot. Loan to valuation, or LTV. Loan to valuation is the amount that the bank is lending you versus the amount that the house costs. So again, let's keep the numbers easy. If the house is valued at $100,000, let's just say, and their bank is lending you $75,000 because you paid down $25,000, that would be a 75% loan to valuation, because the house was valued at $100,000. You paid down a 25% deposit, which would be $25,000. That means the mortgage that the bank is giving you is just £75,000. How much do I need for a deposit? This is one of those things that gets bantied around a lot. People talking about a 5% deposit, a 10% deposit, a 15% deposit. Now, a lot of lenders, the top amount that they will lend loan to valuation wise is 95%. There are some mortgages on the market that go above 95%, but they're few and far between, and you'd probably have to have a really strong profile to qualify for a mortgage above 95%.